Welcome to the Deep Dive. Today, we're digging into the Q3 2025 earnings for, well, a company everyone's watching in aerospace. And this quarter is really something because it's just full of contradictions, isn't it?
It really is. Yeah, quite the contrast. You've got this huge financial hit, a real shockwave on the development side, but then you look at the factory floor, the big production lines, and you see these measurable signs of things getting stable, recovering even.
Exactly.
Yeah.
And that's the tension, right? That's what we need to unpack for you. Our mission here is to go through the source material, the earnings call, the reports, and figure out if those operational wins, the production rates climbing, better quality metrics, are they actually strong enough to handle the financial fallout and the delays from the big development programs?
Right. We need to look at the specific numbers, the rates, the charges, and what this higher confidence plan, as they call it, is really costing them. What are the turning points here?
Okay, let's start with the big one, the headline grabber, the 777X. That seems to be where the financial anchor is this quarter. How bad was it?
It was substantial, yeah. They booked a massive $4.9 billion non-cash charge just for the 777X program.
Wow.
And this isn't just, moving numbers around. It's a full reset of the schedule. First delivery of the main variant, the 777-9, pushed from 2026 all the way out to 2027.
Okay, wait. $4.9 billion. That's huge. For listeners maybe not steeped in corporate finance, what does non-cash charge really mean for how the company operates day to day?
That's a good question. So non-cash means basically no money actually left their bank account this quarter because of this charge. Instead, it's an accounting move. It recognizes that the program is going to be way more expensive to finish than they previously estimated. They're writing down the value of the program assets right now. It hits the profit and loss statement immediately.
Okay.
But the actual cash impact, the money not coming in from deliveries, that stretches out over the next few years.
Got it. And the reason for this year-long delay, is it a major technical problem?
Engine issues.
Yeah.
Wing design.
Yeah.
Usually that's what drives these big slips.
Well, that's what's so interesting here. It's not primarily technical, according to them. They emphasize the plane itself, the engines. They're performing well. Over 4,000 flight test hours, which is actually quite a lot, more than usual.
Yeah.
The bottleneck is certification, specifically getting what's called TIA, Type Inspection Authorization, from the FAA. So the plane flies fine. They have tons of data. Why the holdup on the paperwork? Is the FAA just being incredibly strict now?
It seems that way. The company basically admitted they underestimated how much analysis, how much documentation the FAA requires under this sort of new post-MAX environment.
Yeah.
The FAA's review is just taking longer than expected. They even called it a new process that both the FAA and the company are kind of learning as they go.
A learning process that costs $4.9 billion up front.
And has real cash consequences down the line. Pushing deliveries means pushing customer payments. That delay translates into about a $2 billion cash flow headwind just in 2026. Money they expected next year, that now won't arrive.
Ouch.
They do still expect the program to eventually make money, maybe turn cash positive around 2029, but yeah, the immediate cost of this regulatory caution is very, very high.
Okay, so that's the pain point, the future program delay. Let's shift gears to the positive side you mentioned, the operational stability. The workhorse, the 737 MAX. What's the story there?
This is where things look, considerably better. They really focused on discipline here. They managed to stabilize 737 production at 38 airplanes per month through Q3. That was a key goal.
Right, hitting that rate consistently was important.
And then, crucially, in October, just after the quarter ended, they announced a joint agreement with the FAA, an agreement to increase the rate again up to 42 airplanes per month.
That joint agreement part sounds significant. It suggests the FAA is actually comfortable with their process now, right?
Yeah.
What proof did they offer that quality is really improving?
They gave some concrete numbers, two big ones. First, a 75% reduction in traveled work on the 737 line.
75%. Wow. Explain traveled work for us again.
Sure. Traveled work is basically rework. It's fixing things later down the assembly line or even off the line because something wasn't done right or a part wasn't ready at a correct station. It means inefficiency, defects escaping. Reducing it by 75% is, that's huge. It means the line is becoming much more predictable, much more stable.
That's a massive improvement. That alone must be a relief.
Absolutely. And the second piece of evidence was completing all the rework on those older 737-8s, the ones built before 2023 that were parked. They finally finished fixing them all and shut down the shadow factory they'd set up just for that purpose.
Ah, the shadow factory. Getting rid of that must save a lot of money and resources.
Definitely. It was a huge drain, running parallel operations just to fix past problems. Closing it means they can finally focus all their energy on building new planes correctly the first time. It's a real milestone.
So there are 42 a month now? What's the plan going forward? Are they going to ramp up quickly again?
They were very clear about taking it slow. Discipline is the word they kept using. Future rate hikes will be in steps of 5 planes per month and not more often than every 6 months. So a very measured pace. And it's all going to be based on hitting specific quality and stability metrics, those KPIs.
Makes sense. Learn from the past.
And another small sign of maybe thawing relations or increased confidence, the FAA gave them back limited authority, limited delegation to issue airworthiness certificates themselves for some 737s and 787s. It's not full delegation like before, but it's a step.
Okay. What about the other MAX X models? The smaller Mega 7 and the bigger Mega 10. Any movement there?
Still looking like 2026 for certification for both of those. It really hinges on getting the final design changes sorted out for that engine anti-ice issue. That remains the critical item for the Nega 7 and Nega 10.
Got it. So MAX seems to be on a much better track operationally speaking. Did that success carry over to the 787 Dreamliner?
Largely, yes. Similar story, just different numbers. They've stabilized 787 production at rate 7 per month.
7 per month, okay.
And they're working towards rate 8 in the near future. They just completed a big review, capstone review, with the FAA on that, which apparently went well.
So what's preventing them from going faster on the 787? Is it the usual suspects, like engines or composites?
Actually, the main constraint they called out for the next step, moving from rate 8 towards rate 10 next year, it's seat certification.
Seats? Really? Not
Yeah.
the airframe or engines?
Yep. Getting the specific seats for each customer's configuration certified is apparently the biggest bottleneck right now for ramping up 787 production further. It's kind of surprising.
That is an unexpected detail. Are they planning for even higher rates beyond 10?
They are. They're already investing in expanding the facility down in South Carolina, specifically to handle rates above 10 per month, maybe into the teens eventually. They figure they'll need that expanded capacity around 2028 or so.
Okay, let's pull back and look at the overall financial picture for Q3. You mentioned contrast earlier. There was the big 777X charge. But how did the company do overall?
This is the other side of the coin, the really encouraging number. They generated positive free cash flow, $238 million in the quarter.
Positive cash flow. That's the first time in a while, isn't it?
First time since Q4 2023, so almost 2 years. It's a direct result of getting those production lines stable and delivering more planes.
And deliveries were way up.
Yeah, 160 commercial airplanes delivered. That's the highest number in a single quarter since way back in 2018, before all the crises hit. So strong revenue, too, $23.3 billion, up 30% from last year.
Okay.
And because of that strong operational performance, even with swallowing that huge 777X charge, they actually improved their outlook for the full year. They now expect to use less cash in 2025 than they previously forecast. About $2.5 billion in negative free cash flow, down from $3 billion, though that excludes any potential payment related to the Department of Justice settlement.
Right, that's still hanging out there. What about the other divisions? Defense, Space and Security, BDS? That's often been a source of trouble with fixed-price contracts.
BDS actually showed some real signs of stabilizing. Revenue was up 25%, and importantly, their operating margin improved dramatically. It was positive 1.7% compared to a massive loss, like a negative 43% in the same quarter last year.
It's a huge swing.
It is. It suggests maybe they're getting a better handle on those challenging development programs. And they landed a big contract win, too, a $2.8 billion deal with the U.S. Space Force for a satellite communication program.
Good news there. And Global Services, BGS, still the steady engine.
Yep, BGS just keeps performing. Solid 10% revenue growth, strong operating margin at 17.5%. Aftermarket services, parts that business remains very healthy.
Okay, wrapping up, there are some big strategic chess moves happening, too. M&A activity.
2 huge ones, really reshaping the company's structure. First, buying back Spirit AeroSystems.
Right, bringing the fuselage supplier back in-house.
Exactly. That deal is still expected to close this year. They got the EU's blessing, just waiting on the U.S. regulators now. That's a massive vertical integration move.
And the flip side of that coin.
They're selling off a big chunk of their digital aviation business, including the Jeppesen flight planning unit, selling it for $10.55 billion. That deal is also expected to close in Q4 this year.
So a huge influx of cash right as they're preparing to integrate Spirit. Interesting timing.
Very interesting. Gives them a lot of capital flexibility.
And underlying all this financial and operational maneuvering is the ongoing push on culture, right?
Yeah.
Safety and quality.
Absolutely. They mentioned it repeatedly in the earnings call materials, using employee feedback, rolling out new company values, these daily tiered meetings on the factory floor focused on quality. They're
Mm.
planning another big employee survey before year end. It feels like a sustained effort, trying to genuinely change how the company operates from the inside out.
So if you step back and look at Q3 2025, what's the core story? It feels like a tale of two companies almost.
I think that's fair. It's the sharp contrast. On one hand, you see real verifiable success in managing the existing production lines, getting quality up, stabilizing rates, generating cash again. But on the other hand, there's this massive failure in planning and forecasting on the next generation program, the 777X, driven largely by underestimating the new regulatory reality.
So they've proved they can manage the present, but the future just got a lot more expensive and delayed.
Exactly. They've basically traded the old high-risk, move fast and break things approach, particularly around certification, for a much more cautious, measured, data-driven recovery on the factory floor. They're essentially signaling, we can build planes reliably now, but don't expect us to cut corners or rush the FAA on the next big thing.
Which brings us to a really interesting question for you, our listener, to think about. The FAA gave this company limited delegation to speed up production on the 737 and 787 because they showed better manufacturing quality. But at the same time, the FAA's certification arm slowed the 777X way down because of the rigorous data demands for a new design. So what's the new balance point here? What's the acceptable level of risk being set between efficient production and super conservative certification? And maybe more importantly, what does this tension, this regulatory split brain almost mean for the cost, the timeline, and maybe even the ambition of developing the next all-new airplane? That's something to chew on.